Welcome to the Commercial Real Estate Podcast powered by First National. I am Adam Pawatic with Aaron Cameron at the Land and Development Conference here in downtown Toronto. This is part of our speaker video series sponsored by Fuller Landau. We have a guest upcoming who's a busy man today. He's the co-chair of the conference, which I know is an all-day on-demand kind of activity. But in addition to that, he also, his day job, of course, would be Chief Investment Officer at RioCan. He's made time for us today, and we thank him for it. Andrew, welcome.
Thanks for having me. Great to be here. I'm a fan of the show. I'm looking forward to this. I'll try not to embarrass myself.
We'll try to embarrass you.
Okay, good. We've got some targets. Then. Good, let's go.
Let's do background first. How'd you end up in real estate? How'd you end up at RioCan?
Engineer by background. Spent the first couple years as an engineer working in land development. Found my way into working on a bunch of commercial properties when the boom of big box retail was happening. Worked for a couple, Walmart and a couple other large developers. Ended up getting a job for Lowe's when they came to Canada. So helped them expand across the country. So learned a ton about jurisdictions, developers, all the sorts of things from, buying a piece of land to delivering the keys to the operator. Did a couple deals with RioCan. They were getting more into development than they already had been. Wanted me to come over and work with them, and then kind of stumbled my way into a situation where I was running their development group in a time when there was a ton of expansion. Learned a ton. Great organization. Had a ton of fun. And now with Jonathan Gitlin moving up to CEO as Ed's moved to chair, been given the opportunity to kind of be responsible for both our development group and our investment group, understanding there's synergies between both, and continue to learn in the industry, which I love.
We talked briefly before we hit record about capital allocation. You kind of touched on it there. That you're both in, you wear a few different hats within the organization that I guess would be competing for your resources. And so, CIO, Chief Investment Officer, you'd be making those kinds of decisions. But the market has been shifting so rapidly that what was true 6 months ago was probably did not match what was true 6 months prior to that, which is probably not true, midst of COVID and onwards. You can go looking backwards. So let's talk a little bit maybe about, current investment strategy and how that shifted from the last couple of years. Because I imagine that you got to wake up every morning and kind of go, are we pivoting today? Stay the pivot? Is it?
It's been a bit dynamic. Yeah. Listen, I think, one of the things that myself and our executive team spend a lot of time on, especially in this environment, is understanding capital allocation. And that, that's a fancy word for saying, how are we spending our unit holders' money? Right, our unit holders are giving us the responsibility to run the portfolio we have. Depending on whether it's FFO or AFO, 60 to 70% of that goes back into their pockets. The rest of it, we have a mandate to spend in the most accretive way to our unit holders. So, we spend a lot of time understanding, based on the market conditions, our cost of debt and what's going on. Is it paying down debt? Is it buying back stock? Is it investing in development? Is it investing in our properties? Is it investing more money in some of our tenant deals? So all those things, as you look at the landscape, and, we work very closely with my CFO and Jonathan and the leasing team to understand what the best capital allocation is. It sounds boring, but to be honest, that's our prime responsibility. And we have to be looking at that constantly because, to your point, it shifts, right? Our cost of capital has changed dramatically over the last, through this inflationary period of interest rates. So we're very purposeful about understanding what hurdle rates are and why we spend money on what and at what times.
Well, you just said it sounds boring, but I was thinking the opposite. It sounds impossible.
Could be.
Right? Because you've got, you listed 6 or 7 different things. I'm sure there are more. And at any point in time, one would be the right one, but you don't know that because it's 5 years of future sort of predictions.
Absolutely,
before you are realized that you were right 5 years ago or wrong 5 years ago when you made the decision to make that investment in the first place.
That and allocating capital can be time consuming, and markets can shift while you're trying to pivot and reallocate.
Well, to that point, it's interesting. You say you look back in 5 years, the benefit we have in this organization, we've been around for 30, right? I don't see Ed every day. I see him a fair amount, given he's in the office off and on to do stuff as chair and other things. And Jonathan stays in constant contact with him. And we've been around for long enough that we've seen a lot of this stuff in some way, shape, or form. And we've, employed strategies that mostly have worked, some haven't through that process. So you learn by experience. The other thing we tap our network. We talk to the analysts. We talk to the investors. We talk to our large investors. We try to talk to our retail investors, which is tough to try to gain some insight in terms of what they think, and then process all that and understand how we provide that return. But you're absolutely right. But some of it is simple economics, right? Like we're in an environment now where you run a development pro forma, it doesn't really pencil right now. So we're not going to spend as much money in development unless it meets a hurdle rate that we like, that's accretive to the business. In the meantime, we'll focus on, paying down debt or getting our balance sheet in better order, because as much as the retail fundamentals are great, we're giving up a lot of our growth as interest costs. So we got to fix that.
Is that the best use of capital right now?
I would say across the board, yeah. Like, listen, we've got to run our business. So there's roofs we've got to replace. There's, rooftop units we got to do. There's leasing costs we got to, use. There's construction projects we're going to finish. But universally, our priority right now is to pay down debt to try to provide, our unit holders more of that growth that we're getting out of our retail portfolio and our residential portfolio.
There's a lot of REITs actively buying back shares. Maybe just talk about the comparison of that versus sort of the investment back in your portfolio, paying down debt.
We did a lot of buying back shares in the previous interest rate environment, like right after COVID, before interest rates went up, and it's very accretive. The couple things about buying back shares, like it shows that you've got confidence that your NAV, and I know you guys talked about Jonathan's position on NAV.
He doesn't like it,
which I won't get into. But it's a good reaffirmation to the market that we're undervalued. So I acknowledge that. A couple of things on that, though. I'll use a politically correct term. It's like sugar, right? You get it once. It's not on your balance sheet now. It's no longer, quote unquote, one of the overused terms in the industry, dry powder, right? You pay down your balance sheet as dry powder, right? You buy back stock, you don't get that back unless you issue it. And if in this market, it's tough to issue equity. Like, how many REITs are issuing equity? None, right? So that tells you that raising that capital is expensive. So buying back stock when your line of credit's at 6 or 7, your cost of capital is at 8 or 9, and you're distributing like we are in this 5s and 6s, doesn't make a lot of sense, right? If cost of debt's cheap, it can make a lot of sense, and it can provide a really good hit to FFO.
But if the cost of debt's cheap, likely the math on the development pencils out, and that's where you're going. I mean, we haven't had Jonathan on now in it's been a year or more, I think, but. At the time, RioCan Living was coming out, or it had come out, and there was something like 10,000 units in development pipeline, and there was this big aspirations to grow rapidly to become one of the largest sort of apartment owner and condo developers in the country. There must be some frustration at this point because the math just hasn't really permitted that to happen at the speed at which you probably hoped at the time.
Yeah, I think a couple of things on that. One, our goal was, we did an investor day back in, I think, early 22. Did an investor day, said our aspiration is to, grow that residential portfolio to 55 to 60 million of NOI. And functionally, through organic growth and some acquisitions we've done in the last 2 years, we're going to be there on our targeted time frame of 25 to 26. So we set that target because we acknowledge that residential rental is a great business to be in. It's expensive business to be in. It's it's great income. It grows every year. It's valued as at the lowest cap rate of any of the asset classes, but it's expensive to get into and expensive for our cost of capital right now. So we said we're going to build to that size, and if we can get credit for that from a stock multiple standpoint inside our portfolio, great, awesome. We're one of the diversified REITs that has really two good asset classes that kind of complement each other. If we can't, then we're going to have to do something else with it, because it belongs somewhere else, right? Like if you look at the multiple that the resi REITs trade at, and again, going back to our multiple, which I think is lower than it should, but every public company thinks that, but I truly do believe that, there's a big gap between what that income's valued at inside our portfolio and what would be valued at if one of the res REITs held it. So I think we're forming that thesis, but we're probably there on understanding we're not getting credit inside our portfolio. So we're going to have to do something else with it. Now, would we continue to build this stuff? It's down to each project's return, right? And in this environment with interest costs going up, rents are great. They continue to grow. Construction costs are starting to level off. So there's a time in the future, maybe not this year, or maybe into next year or beyond, where we'll start building this stuff again. But it doesn't pencil for us now, and it's not to our previous comment, it's not our best use of capital. right?
And you still have a handful of units though that were under construction that'll be coming on stream in the near term.
Yeah, we're finishing leasing on 2 buildings, 450 The Well and Rhythm in Ottawa at our Westgate property. So both are, well, I'm going to get these numbers ballpark, but The Well's around 60% leased and Rhythm is almost done. We have not we're not finishing anything else on the res side. So when those 2 are done, we'll have 14 buildings in our portfolio, around 3,000 units at 100%. And at the end of this year, we're probably in the ballpark of 35 to 40 million in NOI.
What about condo?
Condo, we've got condo projects in flight. We've got 1 or 2 that are in sales mode, but kind of chugging along. But as much we're not a condo developer, so if something in sales mode isn't working, then we're happy to be patient for the sales and not going to spend a bunch of money on construction, right? But the condos that are sold and delivering the next couple of years, and that's going to be a huge benefit to us paying down our balance sheet and delivering more, reducing our interest costs, delivering more of that NOI to the business. We've looked at those condos because the concern is, okay, well, are they all going to close? We've looked at them. We sold them all in a market that is, 2 and 3 years ago now. And we've looked at what it is minus the deposits and stuff like that. So there's always things that can happen, but we're very confident those condos will close and we'll be able to deliver those proceeds into the business. Are we starting new condo projects? No one's starting new condo projects.
And we've talked to condo developers who have so far anyway at this point been surprised a little bit by the resiliency of the condo buyer. That when push comes to shove, they're figuring it out, and it may be panhandling to cousins and aunts and uncles to make it work. But everyone seems to, for the most part. I mean, obviously the delinquency on that is a little bit up, but it's not catastrophic, and no one's losing their shirt because of it. When we last couple of times we've had Jonathan on, and now you in a similar conversation, one of the attributes, obviously, of this pivot from exclusively retail to more diverse and adding predominantly rental, because as you mentioned, sort of apartment or residential and retail work very, very close, very, very well together. One supports the other. You had a lot of quote unquote free land that made the development pro formas pencil out probably a little bit more easily than others. We have a bunch of clients that are not in that situation, that are acquiring land or have bought land more recently, that are able to still figure out the math, and maybe their yield hurdles aren't quite where you need them to be, but there's still a lot of people going long. Apartment development. What is it?
Apartment development.
Yeah. How come you guys are just deciding that it's just not the right time?
I think a couple things. I think the apartment developers are looking at it on a project by project basis. Don't get me wrong. There's not a ton, but there's some opportunities in our portfolio that work today, right? It's just when you go and build those projects, it takes 4 years to build them. So is it the right use of capital for us in this environment today? Maybe not. Right?
Are you entitling land?
Absolutely.
So you're getting everything kind of lined up, ready to go.
We continue to do that. We've been at that for the last 10 years. And I think one of the things this environment has taught us that, we've gone back on some entitlements and gotten more density or removed some permissions that were drag in value. Like the City of Toronto has a policy of replacing non-res or office when you redevelop that stuff, and you got to put it back in. We've talked with the brokerage community and the land guys, like Casey at CBRE, like he was speaking earlier today. Like that non-res density above a ground floor is like a negative drag of $200 a foot on the project. So you got to get rid of that, right? You got to work with the city to get rid of that. So we're entitling, we're improving, so that stuff can, for lack of a better term, sit on a shelf and we can monetize it, in the right environment, right? I would argue that right now is not the time to sell land.
You'd argue.
I wouldn't have to argue.
Who would argue with you?
Exactly. And people are taking back structure and stuff. I don't need to do that, right? Like we've got a very healthy business. I don't need to desperately sell land and take back structure to achieve stuff like that, right?
When you do pull one of those off the shelf, you get the green light, you're going to go ahead. Yep. Is it more probable to be condo or rental?
I'd say rental.
That'll be
confidently right now. Listen, some sites, like this gets into the weeds, but some sites are unequivocally condo. There's no doubt about it, right? Like just based on where they are and some of the dynamics and some of the attributes of it, if they're really, really central, really, really high density. But a lot of other sites we like are rental. And I think going forward, we'll look to dilute our interest in condo projects if it is a condo project. So we get below 50 or lower. Maybe we have to stay in to facilitate the project, to help with the covenant without giving guarantees, to be around. But I don't think going forward we want to be participating in condo because it is, it's a lot of capital we're putting out on our balance sheet and we're waiting for that return. right? That's not the type of business we should be in as a REIT.
What happens if interest rates don't come down, and your CMHC insured mortgage rate is going to be 4.5% in the future? What else is it that you need to happen then for the pro formas to skate on side?
It's interesting. So I think it's realistic to assume that for the foreseeable future, CMHC rates might be that. I think that's a more realistic.
Yeah, I was going to ask you what needs to happen for you to build, but I wanted to take interest rates off the table, right?
We'll take interest rates off the table because everyone talks about that. I think rents continuing to grow, and being confident that we're not going to hit an affordability ceiling. So that's geographically centered, right? Like I think there's everyone's talking about a little bit of softness in the Toronto market in terms of affordability. So if we get through that and we can see that, then great. If it's another market, like we're not, I don't think you're seeing that same resistance to affordability in markets like Ottawa and Calgary and Montreal, right? So that's one. Continue rent growth. Getting rid of everyone complains about this. The planning process takes too long, but you'll hear the narrative even around here today. Like 30% of the cost of a unit is wrapped up in DCs and charges and stuff like that. That's what makes the difference to building this stuff. And I'm not even talking about us. I'm talking about the market, right? Like if we saw a lot of that, then we'd be inclined to build more, and we'd build with partners where we can, trigger a land gain in the front end, charge some fees in the back end. The benefit of us being in this development game for a little while now is that we've done a fair amount of it. We've got the credibility to do it, and, we've got a track record now. So we can partner with institutional money to do it. Right, that want this asset class. We just got to be willing to. We got to be in this right spot to want to spend our money on this, as opposed to paying down debt, and we're just not there right now.
How much did the HST removal get your pro forma underwriters excited? Speaking of,
it got me excited. Like, to be honest, the whole industry worked hard on it. So I think I'll leave politics out of this, but the federal and provincial and municipal governments are all trying to work together, not successfully all the time, but trying to work together to make this better. HST helps. I think HST took the return that we need to start one of these rental projects. It filled maybe 50 to 60% of the gap, right? At the same time in Toronto, we went backwards on property tax, which took it away. I think Joyner talked about that and complained about that when he was on with you guys from Tricon. So yeah, we're not quite there yet. I think property tax would help. Getting rid of DCs would help. Improving the timelines. To be honest, I think CMHC, and not to talk about interest rates, but CMHC could be a little more creative in their programs, be a little more aggressive, right? Like RCFI, or now ACLP, if you want to call it. It's a great program. But, we've got one project in Toronto with that program, and the coupon is between 2 and 3. That works all day long, but it doesn't work at 4.5. So if CMHC can find a way to do that, or provide zero interest equity loans, all sorts of creative stuff to encourage the industry, then, if we can get the returns up, I think RioCan is a builder, in partnership with others, once it's the right use of capital. That enough conditions for you? It's a lot
no, that's okay.
Just try not to get in trouble. But yeah, I'm being honest. Like,
yeah,
I think,
of course.
it's a multivariable scenario.
It's a lot
yeah,
of things, a lot of levers, right?
And it's back to, the heart of real estate and investment is it's what's the best use of your money. And right now, you could build and you'd get some return, but you'll get a better return if you spend it elsewhere, which is what you're doing. And that makes perfect sense. Like,
absolutely,
you have a fiduciary obligation to your shareholders, and so by developing, it would be not the best thing for you to do, right? Under that obligation.
If your only business was development, then maybe changes the the answer.
I think it's an arrow in our quiver, right? We've got to have. We believe it's a differentiation for us that we've got the track record and the ability to do it. So it's an option we want to have. We've got the same core competency and excellence in managing retail, and that asset class has never been better. We're 97.1% occupied on the commercial side, and 97.9 overall. 97.9 overall, 97 on the commercial side. So it's we're full, right? Pushing rents. Our leasing spread this past quarter was 14%, right? On the stuff that's rolling.
Wow. On the retail stuff.
On the retail stuff that's rolling, right? So now the retail business is one where, not all your stuff rolls every year. It's different from residential, but those fundamentals are phenomenal. Like, we're getting, and we got back, through some bankruptcies earlier in the year, which affected our numbers, but not too bad. We got back 10 boxes and rooms and spaces and bad boy stuff. We released most of them to grocery stores at higher rents. So the demand is out there. We're working really hard, and our team's doing great on that. And the fundamentals are there. So it's almost like our best use of capital right now is to get the debt down to reveal that growth. So, when we have a conversation with analysts and investors, we're like, then we can further help Jonathan with that NAV discussion, right? We should be trading at a lot higher value, right?
We talked about it takes 5 years to see the fruits of your labor, or decide figure out if you were even right on your decision making 5 years ago. RioCan obviously went through a very we'll call it high profile repositioning 5 years ago. I'll say, just for the conversation's sake, although I think it might be a little bit longer. Do you ever think about how your portfolio would be performing if you'd not repositioned in the current market?
Yes, frequently. And to be honest, John started that initiative when he was kind of sitting in my seat as a senior VP of investments, and I was working with him on the development side, understanding and helping him get through that with the entire team. Like, we look back frequently and we see some of the assets we've sold come back to the market. We're like, really glad I don't own that anymore, right? And listen, there's great operators for secondary and tertiary markets. There's REITs to do phenomenal jobs in those markets, and those markets are also seeing a renaissance in terms of retailers wanting to be there. But, the occupancy is not as high. It's tougher to push rent growth. You're on your back foot. Like, I think some of the proof in the pudding for us is we talk to the leasing guys and they're saying, now I'm walking into a negotiation with one of our tenant partners, and I don't have the ugly stepchild at the bottom of the list that I got to sell, and that I got to basically agree to a lower rent for the great stuff to keep them in that box, right? So now you've got a lot more leasing leverage to work in partnership, and we've got a really large portfolio, so the leasing guys can walk into a meeting and have the confidence that the tenant probably wants every one of those sites, and in partnership with them can push them for higher rents, right? So that's where the proof in the pudding is. CapEx too, like CapEx and the demographics. Like, when we talk about what analysts and investors look for, the demographics surrounding our centers now are at 260,000 people in a 5-kilometer radius and $140,000 in income. That's dramatically improved from what it was 5 years ago. That's the proof in the pudding. When you look at the wrap in our on our MD&A, that's what shows what that did, right? And you can see it in the lift in rents and the lift in occupancy.
Is that reflective of the full retail environment, or is that just because you guys had such a large portfolio, kept the cream of the crop, and you've just really outperformed the market at large?
I would say the full retail market's getting the benefit of that. I would say we're getting a little bit of a benefit on top of that. From a bias standpoint, I think we have the best relationships with the tenants. They want to be in our centers. We have great customer service. We're in partnership with them. I'll give you an example. When a grocery tenant sits with us and says, we're trying a new prototype, we want to get 10 of these stores, we've got enough leverage to sit down with them and say, okay, we might not have the vacancy, but we'll move some stuff around. Let's talk about rents. Let's get you, it's one-stop shopping, right? And then getting them into the box, which is the other part of it, right? Like, it's one thing to lease a site to somebody, but working with a tenant through approvals and landlord's work and getting, all the nuts and bolts with getting a tenant from a lease into a box paying rent is a lot of expertise, and we pride ourselves on paying attention to it, because it means that tenant's going to want to lease with us next time as opposed to the person across the street.
Are you building or buying retail?
Looking at it.
For both?
I don't think we're quite there yet. It's a discussion we're having in our investment committee meetings internally to say, like, okay, when does the math work on us looking at buying on retail? And we're, like, to be honest, we're pretty close to the market. Like, we see everything.
Well, there can't be that many sites that are creative or add value. Like, so you've got like 20 sites, and everyone knows which 20 sites you'd buy on.
Exactly. But we're also trying to be a little bit flexible, right? Like, if we see something that's a little bit outside of the core that we can add value to, right? So, for example, it doesn't have a grocery anchor. We look at the rents. The rents are really flat. We've got the relationship to maybe get that tenant out or renegotiate. If there's an environmental issue, we can clean up. So we've got the leverage to work around the edges to get that stuff to work, but it's tightly held. Like, there's not a lot of stuff going to the market.
It also must be weird, because you'd be thinking, okay, I got this $250 million res investment condo deal, apartment deal, or I can go and spend $18 million on a retail that's a lot of elbow grease. Like the two numbers are not the same.
They're both elbow grease, though.
Yeah,
Like,
I know, but why would you spend the
I
time and
hear ya.
energy on the big one and not? I mean, you have to buy 10 of those retail sites at $20 million
But
a pop. Right?
here's an example. Like the $250 million one comes with a lot of underwriting that you're taking a lot of risk. The $40 million one, you're taking less risk. You know the rents, right? It's transparent. There's triple net leases there that show the growth.
And it's
right?
day one funds from operations.
You got it. It cash flows immediately, and you know what the growth is, and you know where you can add value.
And a better
right?
cap rate probably too.
Like we bought two assets in Q1. We got criticized a little bit from the market for both of them, but one was a grocery anchored retail center in Toronto, Lawrence Plaza, that we're going to work on with our partner there, who's private, to intensify but manage at the same time. And the other one was apartment building in Calgary, we bought 50% of. Both had well below market debt, and that's one of the reasons they both worked.
What was the criticisms for it? For either of them?
Why are you buying right now? You should be paying down debt.
Just blanket.
And our excuse was, our justification was we're actually buying cheap debt and a building or an asset comes along with it. So listen, like we're not going to stop being entrepreneurial and bold and understanding how we want to run our business. That's part of our values, but we've got to be receptive to what the market's telling us, which is paying down debt, and it's working right. It will work because it uncovers a lot of the growth we're seeing in our portfolio.
We touched on KPIs for retail. Aaron and I are big believers in the retail's not dead concept.
That's good. That makes the rest of this conversation a lot easier.
I spent a lot of time in grocery stores and the mall, so I know
exactly.
It's not dead.
You look at your credit card bill. It says, retail's fine.
Which KPIs do you care about the most when you're doing like the 30,000-foot view of your retail portfolio?
Listen, I think we try to make the business simple to understand in some ways, and that the KPIs we care about are the ones we tell people about in our MD&A and our wrap, and in the ones that are broadly consumed by the industry. So I've already rhymed off a bunch of them. It's occupancy, it's same property growth, it's net debt to EBITDA, right? Like,
The neighborhood economics sounds like a really important one also.
Demographic, absolutely.
Like if you're looking at that, like looking for new, I was thinking about the Lawrence Plaza, you're probably looking around the neighborhood going, I expect greater growth here than in other neighborhoods, and therefore this makes a good investment.
It's next to transit. Yeah, it's got density upside. It was well run when we got it. We think we can add some value to it. But yeah, like I think those are the things. Like, when we get into specific investment decisions, we'll do all the math. We'll look at yields and IRRs, and we'll look at our cost of capital, and we try to be really disciplined about how we look at those things, and always running it through the corporate model to understand what the impact on our business is. But yeah, at a core level, Jonathan, my CEO, and Dennis, my CFO, are down in Chicago today at the Desjardins conference, and they're rhyming off the same KPIs I just rhymed to you, right? And we don't want to get too complicated, but those are the ones that are aligned to our business goals and are aligned to how the actual core market is performing in retail.
We're having you back again, we promise. Let's call it 18 months. In 18 months, what are we talking about?
Well, when we see you break ground on an apartment or a condo, we'll know we're into the next cycle.
Yeah.
Then we'll have you back on. That's my market indicator.
What do you think we're going to be talking about then for RioCan in 18 months? Like, where are we going to be? Let's say we're sitting at the Toronto Real Estate Forum next year, 2025. What are you talking about?
I think we're gonna I think the momentum in retail is not temporal. There's maybe I'll dive into this a little bit. I know we're trying to wrap up, but the other story about retail is no one's building it. You can't build the replacement cost is above what it's worth, right? So you can't build and lease it. We're doing a little bit, but you can't build a new grocery anchored center and lease it for what people are paying market rent for to make money. So they're not making more of it. So that dynamic's going to continue with population growth, same fundamentals as residential. So, we're going to continue to pay down debt with proceeds. We're going to continue to prune our portfolio and, invest in our portfolio to provide, our shareholders with great value. I think you'll see some stuff happen on the purposeful rental side in terms of us trying to find a different vehicle to put it in, to do something with it. And we've indicated that to the market in some of our calls because we're not getting credit to where it is. That is also a huge meter mover for us in terms of paying down debt and cleaning, for lack of a better term, cleaning up the story for some of our analysts. As much as we like development and we like residential, we acknowledge that sometimes that's a confusing story. So we'll clean a little bit of that up. And I think there's no reason we shouldn't be trading substantially above where we are.
Can't
John,
wait.
Yeah, John will calm down finally.
What's the stock price?
he'll-
What's the stock price today?
Oh, you're catching me off guard. It's somewhere in the 17s.
Okay,
That's what it's done today.
So a year and a half, we'll chat. We'll fact check. We'll see where we are in a year and a half from now.
Nice,
Okay.
nice.
Okay.
Does that I got to bring a gift if we're below? We're not going to be.
We'll be up.
We'll be up.
I'm
Good.
confident we'll be up.
I like that. I like that.
Thank you. Thanks for taking your time to come on. Really
I loved it.
appreciate
It was great.
That was fun.
It was great.
Thanks to First National for powering the podcast. Of course, thanks to Informa for hosting us here at the Land and Development Conference. And of course, thanks to Fuller Landau for sponsoring the speaker video series. Again, thanks, Andrew.
Thank you, guys. That was a lot of fun.